Hello and welcome to our special show where we will do the money ki baat, and it's safe to say that it's the need of the hour because prices are consistently climbing up and adding to the pain. Getting a loan is now getting more expensive as banks are hiking their lending rates. And that's not all. The worst impact is on the prices of essentials such as cereals and other food products. Now they're all driving the overall inflation and impacting the lower income households the most. So you're not alone if the budget for the month is not adding up this time. I know all of that sounds stressful, but let's unpack them one by one and simplify how you should manage your money at such a time. Where should you save and when can you really expect any relief from the rising prices? First things first, let's look at how much prices have actually risen in the last 1 year for essentials that all of us use. The price for rice has gone up by 7.6%. The price for wheat has gone up by 18.9%. The price for tur or arar dal has gone up by 8.4%. Milk prices have gone up by 12.2%. A salt pack has gotten more expensive by 15.7%. Now, what has been the impact of this? The Reserve Bank of India has been hiking interest rates to control inflation. Now, these rate hikes are aimed to bring down prices by bringing down demand. And they do that by making borrowing more expensive. So banks essentially pass on these higher interest rates to consumers like you and me. That means our loan interest rates go up, but the good news is that the interest that you get on FDs also goes up alongside. You might actually be surprised to know that bank FD rates are now the highest since 2016. So at such a time, should you break your old FDs and reinvest? And how should you really choose between mutual funds and FDs, etc.? We'll answer all those questions and more with our guest joining us, our special guest Rajeshwari Sengupta, who's the Associate Professor of Economics at IGIDR in Bombay. We also have Nilesh Shah, who's a member of the Economic Advisory Council to the Prime Minister and the Group President and Managing Director at Kotak Mahindra Asset Managing Company. We also have Madan Sapnavis, the Chief Economist at Bank of Baroda. We also have Nasir Salim, the Managing Partner at Flexi Capital. And we have Subhash Chandra Garg, the former Finance Secretary of India. Now, let me first start with you, Mr. Nilesh Shah. People's money is now losing value with rising inflation, while salaries have more or less remained the same for many. So as we've discussed, FD rates are now at the highest since 2016. So should people really break their old FDs that had lower interest rates, and should they now reinvest with a new FD?
Well, there's no free lunch in this world. If you break your fixed deposits, it's quite likely that you'll have to pay a penalty. You will earn lower interest rates than the contracted rates. Of course, if you invest back into fixed deposits, you will get higher interest rate. So please weigh the equation, what you are losing versus what you are gaining. At the end of the day, inflation will be always a reality. We are unlikely to be in the world where there will be deflation. We are more likely to be in the world where prices will keep on rising. And hence, I need to be a long-term investor. I need to be a diversified investor across mutual funds, bank deposits, gold, real estate, equity shares. And I need to be a disciplined investor.
Right, of course, the long-term picture is definitely important to keep in mind. And Mr. Madan Sapnavis, if I can come to you next. Now, the rates are rising as the Reserve Bank of India is hiking its lending rate to control inflation. Now, many experts, including you, predicted that there might be a halt in those rates given that inflation went down in November and December. But now with a jump in inflation in January, could there be more rate hikes that could make loans more expensive? How much rate hike would you predict, if any?
So actually, one cannot rule out another rate hike. The reason being that the inflation number for January came at 6.5%, which was much higher than what the market expected. Now, in case inflation remains in this particular range for the next couple of months, I would not be surprised if there would be a rate hike. Though admittedly, after the credit policy, I felt there would be a long pause, though the RBI did signal in an indirect manner that things are not yet under control as far as inflation is concerned. And the fact that the stance wasn't really changed from withdrawal of liquidity to neutral, it meant that the RBI was still a bit suspicious about the trajectory of inflation. So given the fact that inflation came at 6.5%, now we believe that probably for February too, we may be having a number in the region of about 6%. There could be room, though I think RBI may probably pause for a while and see in case these numbers come down, because by the RBI's forecast for inflation in 23-24, it really talks of 5% inflation in the first quarter, which will increase gradually to 5.6% in the fourth quarter. So in short, I would say the pause looks most likely, but in case we get another nasty number in for February, a rate hike of 25 basis points may not be ruled out, which means that automatically some of the loans which you mentioned, the retail loans which are linked to an external benchmark like the repo, would go up by another 25 basis points. But as of today, I think as a borrower, keep your fingers crossed that this doesn't happen. Of course, as a deposit holder, one would be happy, cheerful in case it goes up by 25 basis points.
Right. In that case, of course, there are two sides to the coin. There's good news and bad news both. But that's important that an interest rate hike of 25 basis points is being expected again. Now, that's, of course, after that inflation surprise that came in January. And Mr. Subhash Chandra Garg, the inflation figure in January really came as a surprise to many estimates. Inflation rose when many expected it to be on a downward trend. Where do you think the policy action is going wrong, if at all? And while the Reserve Bank, of course, is hiking interest rates to control inflation, what more do you think we need from the fiscal side, from the government side?
See, the retail or the consumer price inflation is what you're talking about, which is going up. And by its very nature, it's volatile. It depends upon most of the food community, commodities, etc. And that's why you can't predict the path of that consumer price inflation. On the other hand, if you see which is more amenable to rate action, which is the wholesale price index, that is consistently going down. It's headed towards a very low rate. It's less than 5% now and will probably go further down to 3-4% very soon. When we talk about whether it's the RBI policy action or the fiscal action of the government, we should keep in mind what we are talking about. I think there are two big issues here. Number one, the general inflation, which is the consumer price index, and second, the consumers which face for the durables like housing, car loans, scooter loans, and others, which is affected by the rate of interest which is there in the system. The second one is more affected by the RBI action. So that is where a lot of people are facing big problems now. Those who have invested in houses, their EMIs are going up. Those who intended to buy more house or durable goods are probably postponing because they can't afford that kind of burden. So if there is more rate hikes in the system, I think their misery or their difficulty will continue.
Right.
To come back to the government, what you asked me, the government's action is affected more by towards the consumer price inflation. So government took steps like prohibiting exports of wheat and rice, which was supposed to bring down the prices of wheat and rice. But that doesn't depend upon only on the government's action. There is much bigger forces at play. For example, wheat, we are sitting in February right now. If there is, and the government expects rightly, perhaps, that we would receive a bumper wheat crop. But if there is a higher temperature in next fortnight or next 3 weeks, then you would probably have the same kind of effect as it was there last time.
Right.
And that would call for much more of a difficult. So government has to my mind, on the fiscal side, keep its policy action attuned with what happens in the real economy and the real side.
Do you also think there should be a cut in the fuel prices, given that, of course, higher fuel prices really trickle down into the inflation for many other commodities?
See, fuel prices, to my mind, have got internalized now, and the fuel price inflation on both wholesale as well as on the retail side is also coming down. That is the rate over last year, because last year was very high rates, and we have seen 2 rate cuts in last 10 months, so to say. Now, the government may do a rate reduction further to bring the prices a little more down, but it's not justified by any rationale which was there earlier, that the global crude oil prices are rising. That's not the case any longer. It's more of a stable regime between $80 to $85 per barrel. So therefore, this might be for a different reason, not necessarily the inflation.
Right, and while we were talking about the wheat prices as well, Rajeshwari Sen Gupta, if I can come to you on that, the wheat stock is just around 15 million metric tons currently with the government, and that's the lowest that it has been for the last 4 or 5 years. And wheat prices that was one category that witnessed one of the highest inflation in the month of January. Now, after that big jump in the inflation rate in the month of January, which was of course primarily driven by food prices, what's your outlook for the months to come? Do you think there could be a relief anytime soon? Could there be a relief in the prices of wheat? What are the factors that could determine it?
So I think one thing that is very important to keep in mind is that inflation problem didn't really go away over the last 1 year. I mean, we did have 2 months of inflation going down below the 6% upper threshold of the RBI's targeting band, but that was primarily driven by a very steep fall in the price of vegetables. And if you take away the vegetable effect, the headline CPI inflation was still greater than 6%. It was actually close to 7.2%. So inflation as a problem didn't really disappear just because the headline number came out to be less than 6% in November and December. So that's one thing to keep in mind. The second most important thing is to think that what were the 2 main drivers of inflation being so sticky and persistent? And one, as you mentioned correctly, is the price of cereals. So another thing to keep in mind there is, it's again not just because of a January bump in the price of wheat or price of cereals. The price of cereals has been steadily going up from May to December. So roughly speaking, the cereal price has doubled from roughly 5% to 14% between May and December of 2022. And in January, it came out to be 16%, right? Food inflation in general has gone up from roughly 4% to 6% between May and January. Now, within the cereals, of course, wheat has proved to be remarkably persistent in terms of its rise. And the wheat price, again, has been increasing not just over the last couple of months. It has been increasing since July again. And wheat price has roughly gone up from 9% to 22%. So that's a staggering increase. In January, it went up by 25%. Okay, so that's a very drastic increase in the price of wheat. Now, one of the reasons why this is happening is, of course, this reflects shortages. Right, so the government warehouses, as you were saying, the overall stock has gone down from roughly 33 million metric tons in January of 2022 to about 17 million metric tons in Jan, and this month it's down to 15 million metric tons. So there's a steady decline in the shortage of food stock, wheat buffer. So that definitely is something that is leading to this huge drastic increase in the wheat prices. Now, what's the outlook going forward? If this steady decline in the wheat buffer stock continues, and given that the new harvest is not going to hit the market until April, I think that uncertainty still persists. And as it was already discussed earlier, that if there are unfavorable weather conditions, unfavorable temperature conditions, which end up adversely affecting this new harvest, then that uncertainty gets even more prolonged, given that already the stocks are coming down steadily. So I think the wheat price, cereal price, and hence food price. So food is about 46% of the CPI basket. Within that, non-perishables like cereals and spices are about 37%, which means the cereals and spices are the underlying drivers of food inflation, which in turn is pushing up the headline inflation. And I don't think the uncertainty has disappeared on that front. We also have to remember that the government discontinued the free food grain scheme that was done during the COVID times. And then it has been replaced by the PDS distribution being free. But there is a period when the people are going out in the market, and that is driving up the market demand at a time when the government buffer stock in the warehouses is coming down. So that, of course, is going to give an additional pressure on the food grain prices. So I think that uncertainty remains. And one more point I would like to make is, a very, very important component of inflation is core inflation. And core inflation, which is without food and without fuel, has proved to be remarkably sticky and persistent for almost 2.5 years now at 6%. And that core inflation is proving to be very resilient, irrespective of what the monetary policy steps that are being taken by the RBI, and primarily because much of the high input prices, which started during the pandemic and after that global disruptions, are continuously being passed on to the final goods prices, which is keeping the core inflation very sticky. So these two, material price and the core inflation, I think that uncertainty is going to continue for a while.
It's very important to point out to that uncertainty risk, as we said that many were expecting that RBI's action, the monetary policy action, might be on a halt for the months to come, considering that inflation was falling. But that uncertainty remains, and that's what the RBI also said, that they will remain alert on this, and that's why we can expect more interest rate hikes. Now, those interest rate hikes, as we've discussed, make our loans more expensive, and they also are increasing the FD rates. So, Nasir Salim, while we are discussing how people should save their money at such a time, another question is that while FD rates are rising, how should people choose between mutual funds, FDs and equity? With someone who doesn't have enough knowledge about stock markets, with the rising rates, is it time to go back to the old school investing style of FDs? Is it becoming more attractive?
Good evening, Pranchi, and it's great to be with some of the best panelists, including Nilesh sir, who's been my mentor and a trainer for many years. And that question should be directed to him actually, not me. But I'll try to give it a shot. So, Pranchi, I think 2-3 key points there. I think number one, equities, as you mentioned, fixed income, FDs, these are all not just simple products to kind of look at it from a normal perspective. You have to understand risk-adjusted returns. There is a payoff matrix, risk reward, which needs to be understood. And given the fact, to answer your question, particularly on fixed deposits, I must tell you, I think, there is this general belief that, we take out money from fixed deposits and go and invest it in equities. It's not so simple. I think today, if you look at the overall macro picture, fixed income as an asset class is going to be very, very rewarding because it comes in with interest rates going up. And you have the ability to lock in those yields, Pranchi, today, which are available through mutual fund houses, which are very, very attractively priced, which also gives you the benefit of indexation over 3 years as compared to a fixed deposit. So I think the first thing is you get attractive interest rates, which you can park in your funds, subject to time horizon, 3-year indexation benefits thereafter as compared to fixed deposits. And therefore, the net return, if I look at those vis-a-vis fixed deposits, are far more favorable today and have always been favorable even when interest rates had come down pre-COVID and during COVID levels. The second quick point is, Pranchi, I think, I heard everyone mention and talk about interest rates and the impact of the repo and the RBI looking at further or not further increasing interest rates. I think there are two very key important points, and if I can shed some light on that, I think today, India is going through a very interesting phase. If you look at our inflationary pressures, they are far more less as compared to the US. So to kind of think that the differential on the Fed vis-a-vis the RBI, and that the RBI will follow suit to the Fed as something is gone of the past, is not going to happen anymore. The US is going through its own challenges, Pranchi, and I think India today is far more better from a macro perspective, and I personally feel that the interest rate scenario for now has pretty much reached its terminal value. There will be not too much of interest rate hikes unless there is something very majorly that changes, which is not the case. And I think one of my fellow panelists mentioned about the CPI inflation coming in. I think one of the core reasons, if I can say so, is that until December, the central government had given out policies where they were giving out cereals up to 10 kilos every month. That has been reduced now to 5 kilos. And therefore, the impact has created its own pressure on demand. And therefore, CPI has gone up as against WPI. And WPI remains within the risk tolerance of the RBI level. So to answer your point, RBI and also the GSEC, we track the government securities, 10-year GSEC papers, and that would have shown if there was any worry, any reason for the rates to go up further, that would have shown in the yield today. The yield movement has not been at all much on the GSEC and post the CPI inflation announcement day before. So we feel that today, given where we are on the interest rate scenario, Priyanshi, fixed income as an asset class, subject to risk-adjusted returns, your personal horizon, your risk profile, makes a great case for investing over fixed deposits.
Right, of course. So as you mentioned that as the government has also been saying that India is coping better if you compare it with other countries. But of course, Nilesh, I'll have to come to you on that question about FDs versus mutual funds. As Nasir Salim pointed out, well, my grandmother will be really happy if FDs become more expensive, FDs become more attractive. That will save me some arguments with her. But how would you say a normal person should choose between FDs and mutual funds? That's a question that a lot of people have on their minds right now.
To some extent, you are asking a barber, do you need a haircut or not? As a mutual fund manager, I'm always going to say you have to invest in mutual fund.
Absolutely, you have your biases.
Before you decide FD or mutual fund, when you are ill, you don't go to the chemist and buy medicine on your own. You go to a doctor, take prescription. For your financial health, you need to go to a person like Nasir and give him what your requirement is, what your risk profile is, and then let Nasir prescribe a prescription for you. Some mutual funds, some bank fixed deposits, some gold ETF, some equity shares. That over a period of time will ensure that your grandmother remains a happy person.
Well, my grandmother will not be happy about the mutual fund answer or the equity answer. I think that's the old school style of investing, and that is becoming more attractive. But as you said, everybody has their own risk appetite, and that has to be considered. As we were talking about FDs versus mutual funds and inflation at large, Mr. Subhash Chandra Garg, a lot of arguments have been made that inflation in India is largely imported. It's because of commodity prices that were going up globally, and that's why commodity prices and fuel prices went up in India as well. So is there a domestic factor there as well, or can inflation largely be attributed to international factors, and can we say that our domestic factors have no role to play?
I think this is one of the most disingenuous argument that we face very high imported inflation. 50% of CPI is food and the pan masala and other agricultural items. That's all domestic. There is nothing which is imported over there. It's only the fuel, etc., which is 5 to 6% of the CPI basket. Rest, also the clothing, footwear, and the services. These are all domestic. 95% of the CPI is all domestic. And therefore, anyone who says that we are impacted by the imported inflation, it's more the wholesale price index which is more import sort of impacted than the retail. So right. I don't think this is the argument which should guide the policy action or the public discourse about this one. And therefore, since that is not the reason, and it's all the domestic economy which is the reason for the CPI movement here and there, whether it's vegetable, milk, cereals, footwear, or the housing and other services, I think we'll have to deal with that domestically rather than sort of finding either an excuse or something which is not the real basis.
Right. Of course, it's important to pin responsibility domestically as well to come up with solutions. Now, with that uncertainty that's still prevailing about inflation rate, we don't know whether it could go up even further. So at such a time, Nasir Salim, if I can get your closing remarks on this, how should people really manage their money? If we just park our money in banks without putting them in FDs or any investment instruments, that just means that my money is losing value because inflation is rising while my salary remains the same. So where should I park my money so at least it retains its same value with the rising inflation rate?
So Priyanshi, there is no set formula. But again, as I said to you, I think the risk-adjusted risk profile, your risk-adjusted return time horizon will define all of that. But broadly, since I would like to stick my neck out and say this on your show, I think as I said to you, the fixed income category today, looks very attractive because from a 3-year perspective of an indexation, and I think also I don't want to get into the technicals, but if you look at broadly, we track something called the yield curve, and maturities with Government of India papers, for example, G-Secs plus state development loans backed by the RBI. Some of those instruments which carry practically no risk, the only risk is of the sovereign risk that they carry, which is obviously of the country by and large. I think, a horizon of between 4 to 6 years of bond maturities, Pranshi, if I can say so, subject to again your time horizon, your risk profile, is very, very attractive. So, for example, there are the mutual fund houses have been propagating this mutual fund Sahiye campaign, and for the right reasons. Pranshi.
Right.
There is a category called target maturity funds, TMF, which is now getting very, very popular and offer very attractive yields, which can be comparable to the FD rates,
Right.
as high FD rates of being 7.75.
Right.
So those can actually offer you much better taxation advantages, and I think investors who have a fairly patient horizon on fixed income as an asset class can go with some of the larger asset management companies
Right.
issuing target maturity funds.
Right, of course. So lots of options available. It is now important more than ever to manage our money properly so that it doesn't lose its value with rising inflation. Thanks very much to all our guests for joining us and answering those very important questions. So in a nutshell, the uncertainty continues. Inflation could rise even further as well. RBI could raise its interest rates further, as our experts pointed out, and that could mean that loans could get more expensive while FDs could get more attractive as well in the future. That's the entire picture in a nutshell, but of course it's now more important than ever to manage your financial life and think through your investments. We hope this show answered some of your questions about managing your money. With that, it's a wrap. Thanks very much for watching.